Our next guest says low rates are gone, not coming back. Joining us now for more on the markets, Jeff Klingelhofer. He is Thornburg Investment Management, co-head of investments and portfolio manager. I like just reading your notes. I like 4,000 years. There's been a cost of money until the last 10. What could go wrong?
Yeah, I mean, what we've been talking about with clients, whether that be retail investors or global institutions, is the alchemy of low rates is over. Right? For the last 4,000 years, as you mentioned, interest rates have been real, and that's been a tremendous step change over the last 15 years, the decade and a half that we're coming out of. Abundance of capital, a free cost of capital that taught us all that we could borrow, and if we got in trouble, governments would come to our rescue, right? Central banks would come to our rescue. As we look forward, I think this has profound implications for how people allocate capital and ultimately higher volatility and significantly lower returns as we look forward.
Yeah, across the board. The other thing is that I thought was interesting about your thesis is that, so you got three baskets: the consumer, the corporation, and the government. And the consumer is sort of giving us a head fake because they're still okay, sort of, right? So we think, this is not great. Corporations have yet to reckon with a lot of this. Individuals don't have to because they've already termed out with long-term mortgages, so they're not. But the one that we really underestimate, I think, is the government, which is going to have to deal with it front and center.
I think you're right. I mean, certainly what we've seen is the government is late to the party. Interest rates have increased, but as you talked about, right, companies are pulling back. CapEx plans are coming back, and that is having real implications for the labor market. The consumer, the same thing. You're right. They have 30-year mortgages. They've locked in long-term financing at very low rates, but new borrowing is slowing except for the lowest income cohorts where it's actually increasing. Folks are struggling to continue to live the lifestyle that is left. But governments, again, they're late to the party. They will catch up. Just last year, we spent $700 billion on debt service. And as we look forward, that will well more than double.
What will it be? Oh, it will double by when? Next year or this year?
No, it's really 2 or 3 years out. But it's still it continues to be a headwind, right, and on continued government spending.
That's going to have a T.
And
start with a T.
Yeah, correct. Exactly.
Debt service.
Correct. And that will have massive, massive implications because really what we've seen is as much as the Federal Reserve has tried to pull back, the government has made it incredibly challenging because it continues to prop up inflation. That will come down. I would look towards the 2024 election cycle really as being a step change in how the American population thinks about debt.
None of these things portend a great future for financial assets in general, maybe not even bonds.
Well, I think where bonds is, we're back in what bonds were supposed to be.
But rates could still go higher, so it may not be time to buy long bonds at this point either.
Personally, I think we've seen the peak in rates. I think we're definitely towards, if not the actual end of the Fed hiking cycle. 1 or 2 more hikes really isn't what's going to drive markets at this point.
What if it's different this time? If the central banks aren't really going to rescue you, if there's a downturn? I mean, maybe they rescue an absolute banking crisis situation that brings down everything. Yep. But what if they look at a recession and say, okay, we got to live with this. There is more inflation, and this is more important that we stave this off.
I think that's exactly the point. We're coming out of an environment where central banks were doing what they weren't comfortable doing. They were trying to push the level of inflation up.
Then why are you so sure that we've hit the peak in rates?
You can never be fully sure, but it's been a dramatic increase already. And this is we're seeing almost every single data print, things are slowing down. To the point earlier, governments are continuing to spend, and that's making the inflation fall a little bit slower than we might have expected, but things are slowing. I think the challenge is...
Government spending is not going to slow, at least not at this point, especially as you head into an election year.
Not into the election year, but watch the election itself, right? I think that's the key. I think what the American population will send the message is that this is unsustainable.
Neither party has been good at this.
Yeah, so where do you go? We need a new party then.
Right.
But so recession next year, still in the cards for you?
I think it's baked in the cards. I think it's almost inevitable as the consumer slows down.
Run-of-the-mill, plain vanilla recession or something worse or better?
Base case is relatively mild, but the Fed isn't going to come to our rescue. Not until they see inflation below 2% and they worry that it's going to stay there, and I don't think we see that.
You also don't think at this time that there's nothing like we're not heading towards like the Titanic. There's nothing under the surface that's really scary. It's just going to be a grinding sort of nothing's going to blow up, but there's not going to be good returns in stocks.
That's exactly right. You never know what lurks beneath the covers. But really, as we look forward, this is just a classic business cycle. And it's a classic business cycle that we haven't seen really in most investors' history, right? It's not the dot-com bubble. It's not the GFC bubble. And I certainly hope it's not a global pandemic. But it is a shock to the rise in capital.
Or even a financial crisis bubble. Not even that.
Well, we saw that earlier this year. A lot of investors worried, but it ended up to be a head fake.
Yeah, that was like a cold.